Welcome to the Asian Connection Mortgage Podcast, where we connect Asian Canadians together to talk about anything related to real estate, mortgages, and finances, based out of Vancouver. Our host is John Lee, mortgage broker with Arise Mortgage. Grab a bubble tea and enjoy the episode.
If you're a first-time home buyer or you've got a young family, you probably heard the same line 100 times, which is pay off your mortgage as fast as you can. And I get why that sounds good. A mortgage is the biggest debt of your life, and getting rid of it feels like safety. But here's the thing. In today's market, especially around Metro Vancouver, racing to pay off your mortgage can be the wrong move. Not always, but often. This is general information for Canadians, not personal finance advice, so just take it more for entertainment purposes. So let's dive in. For our parents, paying off the mortgage was realistic. Home prices were lower, mortgage balances were smaller, and a lot of people bought one home and stayed there. Now it's different. A mortgage around $300,000 used to be a detached house money. And today in Metro Vancouver, that's closer to maybe a studio or one bedroom, depending on where you are and what your down payment is. And most people aren't buying a forever home as their first home anymore. They're taking steps towards their forever home. So they'll start off with like a one bedroom, then a two bedroom, townhouse, duplex, and eventually house. So if you pour extra dollars into paying down the mortgage early, well, you might be locking money into a home you won't even keep long term. So let's be real. For young families, life isn't stable and predictable. It's expensive and chaotic. There's daycare, maternity or paternity leave. One car turns into two. Strap fees keep going up and up and up. Same with groceries. Someone's hours get cut. A kid needs something. And then there's home maintenance and so on. So here's the risk with aggressive mortgage pay down. You feel ahead, but your cash disappears into the house. Extra payments are hard to access again unless you refinance or borrow from your HELOC or when you sell it. That can mean higher costs later, more stress, and maybe bad timing later as well. So it's not just should I pay debt, it's do I want flexibility or do I want to be locked in? Cash on hand may give you more flexibility. So when you prepay your mortgage, think of it as you're basically getting a guaranteed return equal to your mortgage rate. So if your mortgage rate is say 4%, then extra payments will be like earning 4% guaranteed. That's not bad though. It's safe, it's simple, but it's also not automatically the best move because you're choosing that instead of building other assets. And most first-time home buyers don't have real investment base yet. They have a house and not much else. A home is important, but it doesn't pay your bills. It's not easy to sell a small piece of like your kitchen or something if you need cash. So in a lot of cases, the smarter goal early on isn't paying off fast. It's build a strong cushion and start investing consistently. Now, here's the part that makes people uncomfortable. Over a long run, equity markets have often produced higher returns than mortgage rates. People talk about 8 to 10% as a long-term range for stocks. Well, let's be clear. Well, that's not guaranteed. The market can drop and you have to stay invested through all the ups and downs. So I'm not saying stocks always beat your mortgage. I'm saying if your mortgage is 4%, it's reasonable to consider that investing might win over time. You can handle risk and stay consistent though. And that's a big if. Because if you're going to invest for 3 months and panic sell on the first drop, no, don't do it. Just pay the mortgage. But if you're a type who can invest monthly, diversify for years, then paying off a lowish rate mortgage early might be a slower path to building your wealth. So you might also hear people talk about borrow to invest or fancy terms like the Smith maneuver. This is the general idea. Mortgage interest on your primary residence is usually not taxable in Canada, but Interest on money borrowed to invest can be tax deductible if it's structured properly and used to earn investment income. This is not a casual DIY thing, though. The structure matters, the paper trail matters, the risk is real. So just make sure you set up properly, talk to a professional before doing anything like that. So I'm not telling you to do it. I'm saying there are strategies where investing gets rewarded more than rushing to pay down your home. Another thing is, I want first time buyers to hear that nobody pays more for your home because you have a smaller mortgage. The buyers, this is just a joke, but buyers don't show up and say, "Oh wow, you owe less. I'll offer more money for a house." Home prices is based on comparable sales and what the market will pay. So don't confuse paying the mortgage down with increasing the value. Those are different things. So it really doesn't really matter whether you hold a higher mortgage, a lower mortgage, it's really based on your comfort. So I'm not 100% against paying the mortgage off. Sometimes it's the right call. Paying down faster can make sense if you're stressed about debt and you'll sleep better at night. Now, that's really important. Your job is unstable and you want lower monthly obligations. You're close to retirement and want a guaranteed cash flow. And if you're someone who you won't invest the difference consistently, then this is probably not the best for you and you just pay down your mortgage faster. If you're a young family and you're stretched, the best financial move might be quite boring, but take it one step at a time. First off, make sure you have an emergency fund. Then catch up on essentials, invest steadily. Then after all of that, then you can consider extra mortgage payments. So to close off and everything for first-time home buyers and young families, the goal isn't to be a hero and just crush the mortgage in record time. The goal is to build a life that can handle real life. A mortgage paid down fast feels amazing, but if it leaves you with no cash, no investment, and no flexibility, it's not the win it looks like. Thanks for listening to this episode of the Asian Connection Mortgage Podcast. If you enjoyed it, please subscribe and share it with your friends. And take care, and I'll see you in the next episode.
Thank you for tuning in. If you enjoyed today's episode, please consider giving us a review and subscribing to our podcast on your favorite platform. Thank you for listening, and we'll see you next time on the Asian Connection Mortgage Podcast.